And I guess the key thing that's a little different from dealing with apple pies is it's the interest rate, like Caden said, it's the interest rate that we're concerned about, right? So we're going to be able to lock in that interest rate that we're comfortable today. It's like, darn, if I could get that interest rate, if I had that 120 million today, I would do it because I think, you know, there's interest rates or I don't want to be subject to that risk. And so that's what we're trying to accomplish with the interest rate forward contract. So for some of these, I think the timeline's kind of nice. So just kind of writing a few notes of what Caden said here on the idea is to lock today's interest rate. So we're going to look at what the markets are saying. Hey, if you want to guarantee a 6% rate, let's say that interest rates are 5, 6%, whatever they are, then there's a financial instrument out there that'll allow you to do that. You're going to agree to deliver that. And there's people on both sides of the fence that would be betting this, so it's kind of similar to that you can lock that in. So purchased 120 million. The forward contract, the interest rate forward contract that we're agreeing is we're going to purchase $120 million of bonds. Here we're agreeing to purchase this in the future.
Are we changing the question?
I don't think so. Why?
The reason I'm confused is if I bought that 6-month date, you purchase $120 million bonds, that 120 is going out.
Yes.
And it's saying that it's coming in 6 months.
No, the cash is coming in. So today I'm getting $120 million cash. I know that I'm going to get $120 million cash in the future. So I'm up $120 million. This is cash, not bonds.
Yeah. So you're going to use 120.
So then I'm going to immediately use those 120 to buy the bonds.
Oh, I thought.
So there's an instant flip.
I didn't realize. I thought the 120 was from the bonds.
Oh, yeah. No, we don't own the bonds yet. So all we know, maybe we're a big institution and we struck a deal, a real estate deal is closing 6 months from now, and we know that there's 120 million that's going to be, and this happens all the time in the banking industry. They have major influxes of money that they're projecting to come in, and they want to hedge the interest rate risk that they face with that money. Okay? All right. Anything else on number 11?
No, I know. I'm just confused with what we're talking about.
What's your question?
No, like the question was what forward contract would you seek? So by what forward contract we're defining what the terms of the contract are, not what kind of contract it is.
So the contract that we're seeking is $120 million purchase of bonds at the 6s, at 6%. We're locking in the 6 because we don't know what that's going to be in the future. So that's the variable that we're able to lock. So with number 12, what do we know today? What do we know today from number 12?
You have 25%
Yeah, we're holding. Now our asset we're holding is 25 million. The previous example, we weren't actually holding squat other than a promise to pay that we were going to have 120 that we apparently felt pretty good about. But now today in our portfolio, we're holding the bonds. 25 million of 6s of 2030 treasury bonds, so long-term bonds. And they got a price of 110. But we're planning to do a future maneuver. What forward contract would you enter into to hedge the interest rate risk on these bonds over the coming year?
That would just be an interest rate forward contract again?
Yep, same thing. What are we going to do in the future?
Don't you want to make sure you sell them at that same premium and it doesn't drop at all?
Yep. Yeah, so we're going to agree to sell them. We're holding them now. We're going to agree to sell them in the future at that same rate because the rate is what's subject to change. So with this one, we're holding, which is effectively that price. That's right. Yeah. So the price is subject to fluctuate over the upcoming period. So we're holding 25 million of bonds valued at 110. So they're at a premium right now. And in the future, these are long-term bonds, so 1 year from now or 6 months, I don't really even, do they tell? 1 year. So 1 year from now in the future, we can enter into a forward contract to sell them. We agree to sell bonds at 110. Somebody out there people might think that interest rates are going to rise or fall, and so somebody would like to lock in that, so we have a forward contract and we agree to sell. So that was one of the drawbacks of the forward contract, is finding two parties for large amounts to have to marry up with each other, but some of the large financial institutions can do that. Any questions on that one? What do we got in 13 here? Buy a $100,000 June Treasury bond contract for 108, and the price of the deliverable Treasury bond at the expiration is 102. What is your profit or loss on the contract? So why don't you guys think about that one for a little bit? And by the way, this would be more of a, it doesn't say it in the problem, but more of a futures type arrangement, just because it's in a $100,000 block, so it's one of those chunks. It doesn't really matter actually for the problem too much, but. And that was the problem we did with the Apple prices as we looked at the futures prices, the margin account, all of that stuff.
You're buying it, and then at the expiration date, the price.
Now, Kate, what do you think?
It's
6,000 loss, right? Does that make sense? So we bought them at 108. The price fell, so kind of a long position. The price fell to 102. Now, when we're delivering them, we're selling them at 102. And so the $6,000 loss is also called a 6-point loss in terms of the lingo of futures contracts. Because we have the standardized pricing of the 100s, each point off of a $100,000 contract, since that's always fixed, the $6,000 loss is thought of as the 6-point loss if you're a fancy Wall Street person talking. We lost 6 points on that sucker. We're down. Okay? Questions on that one? All right, number 14. If at the expiration date the deliverable treasury bond is selling for 101, but the treasury bond futures contract is selling for 102, what will happen to the futures price? So think about that one amongst yourselves for a minute first. And it might help to think about how that price changed with the example we went through on Wednesday with the Apple price falling eventually down. So what do you think? What will happen to the futures price? So the deliverable for 101, but the Treasury bond futures contract is selling for 102. So I kind of was trying to think here. The current price. Here's the market price, if you will. Here's the futures price. Remember, they're two different things. We got to start kind of divorcing ourselves of the two things. The futures price has been evolving over time. With our Apple example, it might have started high in a previous time. It's been changing. Every day trading goes on, the futures price changes. And so what would happen here if, hypothetically, was that? Chelsea? If you go down to 101. So because of what thing? What economic thing? Competition, but there's a fancier word. Not fancier than competition and supply and demand. No, but it begins with an A. Arbitrage. Bingo. So due to arbitrage. What is arbitrage? That's a concept that you guys should kind of have off the top of your head. Yes. In what fashion, though? Like to call it arbitrage. There's no risk. Yes, that's right. It's basically a risk-free transaction. So when we buy low, sell high in the traditional sense, the investor's taking on risk, right, to do it. It might not happen. So the idea of arbitrage is when you find an opportunity that is basically risk-free, which is what this would be if we're right at the day before and this happened to be true, then a whole bunch of people would start taking advantage of that, and that would cause it to come together. And so through competition, yes, in this sense, arbitrage when it's in a risk-free setting. Okay, good. I wanted to do options today. Oh, one other thing that I don't think I got to last time that I'd like to just make sure we got in our notes somewhere. So, so how many futures contracts do I need to hedge my risk? Question mark. And so your book just gives you this kind of simple little formula, and I just wanted to make sure you had it down. It's fairly easy as you read through the book. Once you understand a few things about the market that we've already talked about. And so NC, they call the number of contracts. VA is the value of the asset you are hedging. And VC is the value of the contract used to hedge. So it's just, again, once you understand the concept of the standardized sizes, that's all we're really doing here. So you can only buy contracts in $100,000 units if you're trying to do treasury bonds. And so the value of that futures instrument is in $100,000 chunks. And so if you are trying to hedge $100 million worth of an asset of whatever you're trying to hedge, and you're going to use that type of contract, a $100,000 contract is the value that these are traded in, then it just tells you the number of contracts that you're going to buy. So in this case, if you were looking to hedge your 100 million, what would that, how many contracts would you need? 1,000. So now you're going to call up your, oops, that's not a dollar sign. You're going to call up your broker on Wall Street. You're going to say, hey man, I need 1,000 contracts. I need 1,000 50s at the 5s or whatever, in some sort of lingo, right? And that's the way they're talking, is in terms of the tradable commodity is the number of contracts. Okay, let's see, another concept that I just wanted to have down. What we've been doing is called a micro hedge, I think, for the most part. And that just means we have a specific asset that we're holding, like we did with our bank example that had $120 million or whatever. It's a micro hedge because we're doing it for one particular asset. If we're doing it for a portfolio, it's called a macro hedge. So you're participating in the purchase of a contract, trying to hedge the risk for maybe a whole portfolio of stuff. So no big deal. I mean, you're just going to pick an instrument that suits your needs. But if it's specific, they call it a micro hedge. If it's something over a portfolio, it's a macro hedge. Yeah.
With portfolios, like the ideal thing with portfolios is usually have like your diversified risk, so you have stuff coming in at different interest rates. So like with a hedge for that, you're taking like one hedge for your whole portfolio. You just kind of do something that would kind of be like an average of what all your different
possibly, yeah, one of those S&P hedges maybe, or something like that, to try to get rid of that market risk that might be there. Yep. Okay, good. So options.
I have a question.
Yes.
The margin account.
Okay.
So, if you're at that business account, like $2,000, and then you're losing money, like it goes down. to
Your margin account goes
1,000.
down?
Yeah, but then you have to add more money to your account. So aren't you losing even more, or am I misunderstanding?
They take the money as they go. So let's take this one here. If the price changed, but we're not yet to the delivery date, then the broker's going to say, well, your $20,000 margin account is dropped to $14,000. And so it's kind of a pay-as-you-go system of the change in the futures price, knowing that the futures price ultimately gravitates towards to the underlying fundamental at the end of the contract. We're going to pay as we go on that. So when the margin call happens because we've gone below our maintenance margin, with that example, remember we had, what was it, 10,000? So these were just kind of made up numbers, but we had an initial margin of 20,000 of our own hard-earned money that we put into the dealer's account, which is a trust account. It's still our money. So we haven't lost anything by putting 20,000 in, other than the foregone interest, right, that we could have earned on it maybe. So they're holding that money for us. We lost the 6 comes out, and then eventually if it gets too low, they make the margin call, and you have to put more money in. So I don't know if I answered your question completely, but so you are not losing, I think to answer your question, you're not losing any more money than the risk you took by locking in the contract, locking in the price. The person on the other end is they're at the end of the day, that last thing we did kind of makes up the margin account makes up the difference between the agreed upon price and the market price. So if you look back to that very bottom part on the Apple example, Apple prices plummeted to 10 cents a pound. These two parties in the past agreed to 20 cents a pound. So we preserved their agreement at the end of the day through the margin account, through the adjustments in the margin account. Okay? Anything else there? I think we'll save options for Monday. This is going to be kind of fun. Let me, I guess, discuss it, and then we'll go through an example on Monday, though. So, option to buy. And I literally mean just discuss it. I just want to take a couple minutes since we got this forward contract on our head. We got the futures contracts, hopefully, in mind. So, what's an option to buy? That's a little bit different. First choice, right? So, at this future date, at this time, we have now the option to buy it, but we don't have to. So everything we've talked about so far, we've obligated ourselves on the front end to do this deal in the future. With the option, we're going to say, hey, I'll buy, which is a completely different, so it's traded separately on the exchange. We're going to have the right to buy it in the future. And in order to do that, why would anybody be crazy enough to give you the option to buy something? I mean, because they get a premium for it. So it ends up being kind of like an insurance arrangement in a sense. So, hey, I want the option to buy it. I think that stock's going to go up, but I'd rather just know that the most I'm going to lose is $2,000. I'm willing to step up to the roulette table. And I don't have $2,000 in here. I'll put $2,000. I know that the most I'm going to lose is $2,000. Right? So it's kind of an insurance. Whereas we don't have that here. With the margin accounts, we had to we had an agreed upon price, but then after the fact, we learn, darn it, I made a mistake, or hey, I made a good decision. So that is the option concept. That'll change the dynamics slightly. So it's a related twist that we put on for that problem. Okay, so let's pull out Allison. All right. So, all right, so who wants to kick off? Let's try to kind of focus our thoughts on chapter 6. What did you find interesting? Yeah.
I guess we should start off with the first paragraph where it talks about how important banks are in the economic environment, especially when it says they fund important investments that not be made. When I first read it, my initial thought was like small businesses.
Yeah.
And oftentimes they aren't able to fund their own large projects.
Right.
So if you're trying to build a new building to become more productive and efficient, they're not going to be able to without a bank's loan. So
Yeah.
it really does make sense.
They really do lower transaction costs.
Yep. Yeah, I was hoping that I like that he kind of reviewed what we kind of like all think we know, but to me when I read it, I'm like he gives a nice step back from the market and think about how money's flowing to the most productive uses. I thought, at least that's what I read too much into it, but I think that's what you're touching on a little bit.
Yeah, and how they can do that connection, because there's like people that have these like large like the large companies that have like a large amount of funds, but the small companies, like you're saying, small companies can't always make those big investments, so then it makes them pull together multiple small ones to make those. They're just being like the connection between what's available and what.
Right. And from the human action standpoint, it seems like it's kind of an acknowledgement that you don't have to be a big corporation to have a good idea, right? So from a philosophical standpoint, if you will, about capitalism, is we're acknowledging that a single great idea that's very good for the economy can emanate from a single person, and then they might have trouble without the right connections, blah, 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 to do that. But with the local banking system at that level, where they can go in and talk to their local banker and start the ball rolling and start to understand, whereas that same person going to some other groups might be like, hey, I'm busy, I'm not going to talk to you. So, okay, what else?
On his point on the fractional, or like really against the fractional reserve system, wouldn't that kind of end up basically putting a brake on liquidity though? Because that more or less would, if banks aren't fractionally reserved, they don't have the central bank as the last resort to bail them out of situations. Wouldn't that essentially put a slowdown on bank loans that were going out to small businesses and other small projects?
If it was eliminated,
Yeah.
yes. Yeah, that would, And so he's making an argument here. You're talking about this page 69, some Austrian economist. Yeah, because he's probably a little more Austrian in nature that we learned about in entrepreneurial and kind of free market type stuff. But he's not up for getting rid of the banking system. You'll hear some people on the shows, abolish the Federal Reserve, go back to the gold standard, we can, whatever. And so he's actually going against that here, saying that, hey, there are problems with our current system, is what he's kind of going through the whole book, but we're not going to throw the baby out with the bathwater concept. So.
You'd be the one to laugh.
Why, have you been doing a lot of babysitting and?
Oh no.
Oh,
Just
okay.
enjoy baby jokes.
Oh.
I'm going to say just enjoying baby food. Is it like, okay.
So anyway, I think he would like to see different things in place, and that's what he foreshadows at the end of one of his policy prescriptions that'll do.
I liked how it was talking about the bubble bursting and how there's a misconception that it was the actual bursting of the bubble that caused us to have like issues in our economy, but that was the market's correction, and that like without that bursting of the bubble, we would have kept doing all the bad things that we should not do.
Yeah, I think that was good insight. What page was that on? Was that towards the end? Yeah. Oh, 77. Oh, you're in the next. Yep, you're in chapter 7.
Sorry.
I knew that's a good thing to talk about, and since you brought it up, I just wanted to comment. One other thing related to that is how the active monetary policy suppresses that correction. So if you think about that bubble bursting, like he's saying that the free market would have popped earlier. But since the Fed says, no, affordable housing is good, interest rates are starting to rise, no, let's push it down. Interest rates are starting to rise, let's push it down. Let's have fiscal and monetary policy through changes in Congress to have affordable housing programs, blah, 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 all the stuff we're starting to learn about here. Let's keep pushing it down, and then, of course, what's happening all the time is that there's upward pressure making the burst bigger if we suppress that natural market correction that would happen.
So just increasing disinvestment.
And making the burst bigger.
Like delay the increase in
Yeah. So if we think back to the philosophy that I do in principles class with the ups and downs of the economy, and the big question is, can we use government policy to make that ride a little smoother? Right? So the ups and downs, the perception, kind of mainstream perception, is that, oh, if you let those crazy capitalists do their own thing and untouched without government, it's going to be a wild place to live in. And we can use government policy to smooth out the ride. This argument is, you're making the ride rougher instead of smoother, perhaps. So that's part of the argument. Okay, other things on chapter 6?
I liked how he kind of pointed out that there's a difference between liquidity and solvency.
Yes.
And he called out Bernanke. He's really good at calling people out. He's like, Bernanke, being an expert on the Great Depression, treated the recent crisis before a liquidity issue instead of a solvency problem.
Yeah.
And so I never really understood the difference.
Okay, right. And we talked about it a little bit earlier in class, but I wanted to bring that up. I'm glad you did. So solvency versus liquidity. What is the difference?
Liquidity, well, solvency is they just are totally gone under, pretty much.
Pretty much. Not necessarily like out of business yet, though, but if you are insolvent,
Negative capital.
assets versus liabilities, right? Your capital account is negative. So if and you guys might be in that position as college students, that the value of your assets minus your debt, if you've got a big student loan debt, you might be sitting negative, right? So technically you're insolvent. In other words, if the government said, you guys got to pay all your student loans back right now, you couldn't do it. Even if you sold everything you got, your car, your laptop, the clothes on your back, every single asset you got, you could not make good on your debt. That's insolvency. So what's liquidity issues?
Cash flows.
Cash flows, good. So that's the income statement, balance sheet stuff, right? So when we think liquidity, we're thinking flows of money on the income statement. When we're thinking solvency, it's more on the balance sheet. What's up, buddy?
Oh, I said that you could sell your eggs. You're being sorry.
For eggs in a basket type of thing?
Never mind.
All right.
Thanks for trying to rescue it, Russ.
I'll stay out of it. Okay. I know when to jump in and when not. All right.
That is that's an entrepreneurial spirit. So chapter 7.
Anything else on chapter 6?
Well, he again slams the FDIC, saying their solutions are short-term and their long-term effects are just make the problem worse.
Yeah.
That's just what he's been saying every chapter.
Right. The long term versus short term, that we're kind of taking the short term fix, which is human nature at a big macro level, right? We look for that immediate satisfaction. If we're depressed, we go out and buy something. And we don't have the money to buy it, but we go out and buy it anyway because I'm going to feel good if I have new clothes and I just spent $150 at the mall, even though you don't have the $150, right? So we kind of look for that short-term satisfaction. We see this at the national level, potentially. Okay?
The last sentence on page 72, instead of being countercyclical, the things that interesting how it keeps going back in like psychology.
Yeah.
And wraps it in like, I think I put my chapter 7 post that he's really pro psychology on the fact of economics.
Yeah. That is the Austrian in him. That's kind of the Austrian flair, is to bring in the human action aspect into it, psychology and other things,
Well,
that,
he brings
how they
in
can
the
affect.
next chapter about housing prices.
Yeah. Yep.
Human action.
Yeah, so I just wanted to hit one last time. I think you guys got it, but the fundamental difference between this Great Recession and the Great Depression with the solvency is that we had a bunch of people that were upside down with the balance sheets. Great Depression, we had the liquidity problem that the Fed wasn't there feeding money to provide the liquidity. And so those are the fundamental differences that Bernanke would never come back publicly and admit that that was the issue. I think it can be debated with Allison whether that is true, but it's an interesting insight on being the starting place and why that wasn't necessarily the right answer for our times. Okay. Yeah, I think there's some good stuff with investment banks in there too, but we better move on to 7. Okay, so who hasn't talked yet? Go. What do you think about chapter 7?
The first page there, it says it was misinvestment on the correction. That was interesting. Because, like you were saying, in 6 and throughout 7, you were saying the verse was happened out of the cycle of the economy. And so there wasn't a misinvestment, or it was a misinvestment that caused the verse. The correction didn't actually directly reduce. It was the compounding of all the necessity, all the acts.
Mm-hmm. Yeah, good point. Who else who hasn't spoke yet? Jason, I think we're falling on you. Any thoughts on chapter 7? Did you read it?
Yeah.
Okay. What do you think? What's your thoughts?
Well, the only thing I thought was interesting is it ties into the end of chapter 6 and the beginning of chapter 7. I like the idea of the acceptance. We kind of talked about it at the end of class the other day about the difference of how economists think versus how regular people think on acceptance.
Okay. Was there a particular spot in the book that you saw this?
It was at the end of chapter 6 and the beginning of chapter 7. They wrote a talk that mentioned acceptance and action.
This kind of ties off that, but on page 74 it's talking about the housing bubble
I think part of that was that they didn't even fall quite. It's always hindsight 2020. So one thing that I've noticed when I've been learning economics over time is you kind of read this, but it's helpful to try to place yourself in the moment. So when housing prices have fallen 15 to 20%, we think, oh, we must be at the bottom. 30 years, real estate's always been going up, and then little did we know that the bottom was really at 30%. But afterwards, looking backwards, it's easier to say that than it is now living in the moment, and how that can change human behavior. Hindsight's 2020, woulda, shoulda, coulda, when we know after the fact. So.
Probably if falling 5 or 10% was enough to send panic through.
Yeah, exactly. Yeah, right.
I was talking about they didn't fall as fast as they should have because then the government still kept doing stuff to try and get them not to fall that fast.
Right.
And so he was like, they still should have been, because I think when this was written, he was saying like, they're still not quite to that percentage where they should be. They're still, or like maybe they just got, I don't know, he was saying something about how they didn't fall as fast as they would have had the government stop. They got like that panic, they like start panicking, and so then they start putting policies and
Did anybody highlight the WAMU comments on page 75 and 76? I thought those were especially insightful. What did you come up with there?
On about page 75, I read a line that said, like, until the WAMU failure, the idea had been that uninsured depositors would impose discipline on the reckless bank, but knowing in advance that they could lose money in the event of bankruptcy. And so, I think it was kind of repeat, just go back to the, before they had this deal where the FDIC just, like, paid everybody back. Like, those uninsured depositors were the people that kept the banks in check.
Yeah.
And caused them not to make too risky of actions and everything.
Yeah, I thought that was an interesting point too that I wanted to bring up. So I'm glad you did on that. I didn't think about the big players, so to speak, right? Because if you're an uninsured depositor, remember you're still insured up to 100,000.
Yeah.
But if you're one of the big players that have 500,000 at the bank, then they're saying you are potentially the one saying, "What's this bank doing? You're at risk." So all of a sudden you're presumably, not necessarily, but you might be a more sophisticated person that understands banking and business. If you were a silver spoon person or a Hollywood movie actor, are you going to be able to impose much market discipline on the banks? Probably not. Right? So, it's not totally fair to assume that uninsured depositors would do that, but I thought that was an interesting comment.
Well, I kind of liked what he was talking about. He said that Bernanke and everyone else who decided to go in for the FDIC to bail out the uninsured depositors, and we're always doing it for the psychological effects and trying to keep markets going and trying to keep the panics off. That made sense. He gave that credit. He's like, look, this is a valid idea.
Yeah.
It's just if you're going to do that, pay it out of the FDIC. Don't actually end up screwing up the bondholders because they ended up accidentally shutting the capital window down, the capital markets down.
Right. So what was the capital window thing? I think that was the next part that almost ticks me off. When there was another thing that I didn't get fired up about enough earlier. But that was one thing about closing the capital. That wasn't immediately obvious to me. What did it mean by closing the capital market for the banks?
Nobody wanted to buy.
Okay, correct.
Say nobody no longer wanted to buy bonds because if banks went under, then they would their bondholders would get paid.
Well, with the capital in the bank, those are the owners of the bank. So remember when the bank's assets fall below a certain level, they kind of have to have a capital call according to the regulations, banking regulations. Remember the actual owners of the bank have to dip into their wallet, kind of like our margin call analysis, and put money into the bank. They have to capitalize the bank. And so is closing the capital market here kind of meant the banks can't attract new owners. Like, hey man, I got this bank, we could use a little money, we're looking for a capital injection. And they're saying, why would I do that? I could do a bond and get bailed out. I could put my money into debt financing for you rather than capital financing. So I could do a bond and then ultimately be bailed out by the government if you don't pay your bills. So that was an interesting distortion that I had never thought about that the bailouts did and disrupted the whole system.
He had a valid point. It might have been part of why everyone was so antsy and said we need to get TARP passed because they knew that it's screwed up.
Yeah. Okay, looks like we're out of time, folks. So for Monday, we'll just do the next chapter, chapter 8.
He killed the dogs.
Oh, I know. I like that example.
That was so dramatic.
And he was like,
I rolled my eyes.
You didn't really, like, yeah, that is really dramatic.
dramatic.
I rolled my eyes. I'm not gonna lie.
All right, so is this egg